If there's one market in the US that is likely to take an unfavorable turn, it's the housing market. What used to be stable and friendly has turned unpredictable and brutal, especially if you're shopping for a new house. The ballooning prices just seem to grow worse every day, and it makes you wonder if the American dream has finally died. From California to New York and every other major city, new home buyers are unhappy and disgusted, while those fortunate enough to buy homes 15 to 20 years ago are thanking their stars. Back then, most houses only had interest rates of 3 to 5%, so paying up mortgages was easier. But buyers in this unfriendly market are basically being strangled to pay their mortgages, as we can see from this Homebuyer Debt-to-Income Ratio chart. This chart tells how much of their taxable income US citizens use to pay their mortgages. A healthy value should be 36% or less, but we are currently witnessing an all-time high of 40%. No one knows if this is the climax or just the beginning. Paying 40% of gross income for home debts is quite disturbing, given the current economic recession and high taxes from the government. Buyers are practically squeezing themselves financially in this market to afford to pay rent. Even down payments on new homes are now smaller than ever. Currently, the average person puts down about 18% on a mortgage payment, compared to 22% in 2006. So you can see that affordability has become a big issue in this current housing market. The only thing new home buyers are holding on to right now is the belief that the current home bubble will pop. But if so, when? Well, before we go into all that, take a minute to like this video and subscribe to this channel. The 2023 July data from the Redfin Homebuyer Housing Payments chart shows that a new buyer is paying about $2,600 for an average home in the US, compared to $1,300 as of 3 years ago. Interest rates have also jumped to a shocking 6.78%, inflicting double damage to home buyers. But it's mostly for new home buyers. You see, most people who are already paying a 15 to 30-year mortgage today are doing so at a rate below 6%. Even if you observe all the mortgages in the US right now, you'd see that 90% of people are paying below 6%, and 25% are paying below 3%. That's enough evidence to suggest that new buyers with fresh new mortgages are the ones suffering the most. But there's a slight twist to all this. Since a major percentage of home buyers are already paying mortgages at low rates, the new buyers being added have little or no effect on the overall community. And besides, fewer homes are sold now, more than ever. Statistics from the National Association of Realtors have shown that the number of homes sold in the US is 40% less compared to 15 years ago. On top of all that, about 40% of homes are bought or owned directly, without mortgages. And so we can see that even DTI charts can't tell the full story of what's actually going on in the housing market. Sure, home prices and interest rates are increasing, but the market isn't fully playing out the way these charts depict. Several local catalysts influence the behaviors of the real estate market in every metropolitan area of the US. These catalysts typically influence that region's demand and supply, so you may not find these general charts playing out the same way they're shown. In fact, you may discover that what's going on in your local housing market is the total opposite of what's depicted in these charts. Every market in the US is a special entity of its own, and no one real estate expert can accurately tell all their behaviors at a given point in time. What you find on charts and statistics is what's believed to be happening on a national level. Let's take the S&P Case-Shiller US National Home Price Index, for example. Going by this chart, you can see that home prices are currently spiking in the US. However, even now, there are areas where prices have decreased, which directly contradicts this chart. And just so, these variations in behaviors across different metro areas aren't just because of the current housing bubble. It's something that has always been attributed to real estate. There have been countless examples throughout history where this exact scenario played out. One such example is the real estate crash of 1990. The National Case-Shiller Index at the time showed a 3% drop from April 1990 to March 1991. However, the LA Case-Shiller Index showed a 7% dip for the same period, and it went on a bear run from there. You can see from this LA Case-Shiller how from that same March 1990 till the early months of 1996, the region suffered a whopping 27% dip in the price index. Meanwhile, on the national level, the trend line was climbing steadily from 1990 to 1996. You can bet that some cities in the US didn't even notice the 1990 crash. In fact, certain markets were bubbly at the time. However, home investors, especially those in LA, found themselves in hot water during this period. It was like hell. Some areas like Beverly Hills even recorded up to 50% price crashes. You're probably asking yourself, what's the point of all this data? Well, it's to give you a perspective and make you understand that something very similar may be happening in 2023. It shouldn't be a surprise if some neighborhoods are already experiencing significant declines, while other markets continue to swell. This is what some experts are calling the hidden crash. Just as the crash of 1990 was more monumental for LA and other cities on the East Coast, the highly anticipated crash of 2023 may be happening already, just not on a national scale. Knowing this fact will save you from blindly following national charts like these. Even now, there are a few markets where prices are crashing so badly that they seem to deviate so much from these nationwide statistics. However, on the general scale, home prices are still pretty much on the rise, and this is largely because the supply is very low. You see, just like any business or market in economics, the supply-demand relationship heavily influences prices. Homeowners are now reluctant to sell their properties due to current market conditions. It's fair to say that no one would want to exchange their low interest rate of 3 to 5% for a 7% rate. Certain regions like San Francisco are suffering negative effects like outrageous interest rates and crazy bidding wars. All these are thanks to the low inventory situation in the US housing market today. There aren't many home listings right now, and there aren't enough home builders either. Some entire metropolitan areas have less than 100 homes up for sale. It's in markets like these you find the most awkward price spikes because it's very sensitive to even the smallest changes in demand. If the number of willing buyers in an area suddenly increases, prices will shoot to all-time highs. But the reverse can also happen if buyers are shortlisted in the area. This entire scenario of few, inconsistent trading in the home market plays into what financial experts would call low liquidity. Low liquidity is when there are fewer opportunities to buy and sell in a market, and trading of assets is difficult. The only way to remedy the housing market right now is by adding more inventory, in other words, building more houses. Otherwise, it'll only take 1 or 2 houses in an area to sell for a monumental price, and others would follow suit instantly. Historically, high demand in the housing market has favored home shoppers. As a buyer, you saw several listings available in a particular area and had the flexibility of choosing the best deal. But now, investors and former homeowners are the only ones cashing out in this low inventory market. Coming back to the supposed crash that seems to be already happening in some metro areas. Well, we'll just have to wait and see if it builds up to become a nationwide issue. But even if a nationwide housing market crash does happen, there's no telling how long the crash will last. According to Redfin data, as of April 2022, single-family homes cost about $2 million on average. But by January 2023, prices fell to about $1.4 million. Today, prices for this same kind of home may increase to $1.6 million. If a crash does happen on a national scale, we'll experience price adjustments, but there's little chance things will play out the way they did during the 2008 crash. Remember, the government has learned a lot of lessons since then, and investors have too. So, there's no way they'll sit back and allow another catastrophe to repeat itself. Investors may begin pulling out their money by the end of 2023 if what happened in Austin, Texas last year starts playing out in other major cities. From May 2022 to February 2023, home prices in this region dropped by 23%, starting a real panic among investors. But this huge dip didn't affect the national stats so much, and it was mainly factored by increased mortgage rates. Having something like this repeat itself on a national scale would literally call for panic, because some experts have claimed that a mega crash worse than what occurred in 2008 is coming. It's predictions like these that make home buyers lock up their wallets. No one wants to buy properties in a market that's on the verge of collapsing. But will it really collapse? Will the current bubble burst anytime soon? Certainly, this wouldn't be the first time we were wrong about real estate predictions. The real estate market is one that can put up a long struggle because it's one of the most active markets in any country. It wouldn't be surprising to find home prices continuing to soar even higher until next year. This would be a nightmare for buyers, but a sweet pie for investors and flippers. Amidst all this, some people are claiming that this is normal market behavior. But if you reviewed all the data we mentioned so far, you can easily come to a different conclusion. If there's one thing we can agree on, it's that a huge part of this current market behavior boils down to the 2020 pandemic. Ever since then, our home market charts began to deviate from past trends, and prices and interest rates began to take on a shape of their own. Inventory also reduced drastically. Just check out this Alto single-family active inventory chart to see what I'm talking about. In summary, the only way a market crash could happen in the short term is if more inventory is added. Otherwise, there won't be any relief this year, and the supposed crash will be put on hold. Remember to like this video and subscribe to our channel if you found this content valuable.